Welcome back to Investor Web. Let's take a look at what's fiscal policy. Fiscal policy, sometimes called budget policy, has two major components: government spending and taxation. Government spending affects the economy by affecting aggregate demand. Taxation affects it by changing people's disposable income, which in turn affects their consumption and saving decisions. Fiscal policy can be adjusted to affect inflation, unemployment, economic growth, and other macroeconomic variables. What is fiscal policy? Fiscal policy is a government's approach to managing its tax and spending in order to affect aggregate demand. Fiscal policy typically falls under two categories: discretionary fiscal policy or automatic stabilizers. Discretionary fiscal policies are made on an annual basis as part of a budget, while automatic stabilizers are unchanging year over year, although they may change within each year. Discretionary policies include temporary stimulus packages like tax cuts or increased public spending. Automatic stabilizers include programs such as unemployment insurance, UI, that increase during times of low economic growth and decrease during times of strong economic growth. When fiscal policies are enacted, they have an immediate impact on our wallets and bank accounts. This can be especially true during a recession or depression, when governments and central banks around the world cut spending in order to reduce unemployment and help spur economic recovery. Fiscal policies can affect things like interest rates, wage inflation, government spending, and taxation levels. If your paycheck has ever felt paltry compared with what it once was, it's probably because of fiscal policies enacted by your employer's employer, the federal government. The purpose of fiscal policy is to influence an economy's performance. By definition, fiscal policy isn't something that a government can implement on its own. The state needs cooperation from other institutions, such as banks and credit card companies. Governments will set up incentives for people and organizations to save more money or pay less taxes than they would normally owe, and then track those incentives in terms of their effectiveness. When it comes down to it, every action that a government takes towards an economic goal counts as fiscal policy. Monetary and fiscal policies have been around for centuries. The gold standard of yesteryear is no more, but central banks still control a nation's currency supply. By expanding or contracting it, they can influence inflation and keep prices steady in response to changing economic factors. But monetary policy doesn't work alone. It needs a partner in crime, or rather, in government, to be effective. This is where fiscal policy comes into play. Through taxes and expenditures, fiscal policies affect individuals by increasing or decreasing demand for goods and services. If you've learned something, don't forget to like, subscribe, and share the video.